When most people hear the word options, they immediately think it's some super complicated, risky way to gamble on stocks. But what if that's not the whole story? What if you could flip that entire idea on its head and use options to generate actual consistent income for your portfolio? Well, today, that's exactly what we're going to break down, how you can literally get paid to trade. Okay, to really get this, let's just forget about the stock market for a minute. Imagine this real-world deal. You find the perfect house, and it's listed for $300,000. You love it, but you're not quite ready to pull the trigger. So you go to the seller and say, hey, I'll pay you $5,000 right now if you'll lock in that 300K price for me for 1 year. The seller agrees. Now, fast forward a year, and the housing market goes absolutely nuts. That same house is now worth $350,000, but because of your deal, you can still buy it for $300K. That's an instant $50,000 gain on paper. But what if the opposite happened? What if the house's value dropped? Well, you can just walk away. The only thing you're out is that $5,000 fee. See the key here? You had the right to buy, but not the obligation. And believe it or not, you now understand everything you need to know about how an options contract works. Seriously, that simple real estate deal is the exact same logic we're going to use in the stock market. And what's so cool is how perfectly it all translates. So the house, in the stock world, that's just 100 shares of a stock. That $300,000 lock-in price we talked about, we call that the strike price. Your $5,000 reservation fee, that's the option premium. And that 1-year deadline, well, that's the expiration date. It's really the same concept, just with a different set of names. Okay, but here is where everything changes. This is the big pivot. In our story, you were the one paying the $5,000. But what if you were the seller? What if you were the one on the other side of that deal, collecting that $5,000 in cold, hard cash, right up front? And this really gets to the heart of it. Every single options trade has these two sides. You have the buyer, who pays the premium for the right to do something. They're betting on a big, dramatic price swing to make money. But then you have the seller. The seller is the one who collects that premium and in exchange takes on an obligation. The seller is betting that things will stay pretty calm, that the option will just fade away and expire worthless, and they can just keep the cash. So let's put this into practice with our first strategy, which is selling calls. And the best way to think about this is to imagine becoming a landlord for the stocks that you already own in your portfolio. So here's the setup, and it's actually incredibly simple. Let's say you already own at least 100 shares of a stock you like. We'll use Apple as an example. You then sell what's called a call option. This is basically an agreement where you give someone else the right to buy your 100 shares from you at a specific price, a strike price. That's higher than where Apple is trading today. And just for selling them that right, you get paid a cash premium right away. And this is the part you're going to love. That premium, let's say it's $500, goes straight into your brokerage account instantly. It's your money. You can do whatever you want with it, and you get to keep it no matter what happens with the stock. You've just generated real income from stocks you were just holding anyway. From here, only two things can really happen. First, the stock price just chills out and stays below that higher strike price. If that happens, the option expires worthless. The buyer doesn't want your shares. So you keep your 100 shares of Apple, and you keep the $500. It's a clear win. So what's the second outcome? Well, the stock does great and rises above that strike price. In that case, you honor your agreement and you sell your 100 shares at that higher price, which means you've locked in a profit. And guess what? You also get to keep the $500 premium. It's a win-win scenario. All right, let's look at the other side of the coin with our second strategy, selling puts. Now, if selling calls is like being a landlord, then selling puts, this is like being a super savvy shopper who gets paid to wait for something to go on sale. The setup here is just as clever. Imagine there's a stock you really want to own, but you look at the price and think, it's a little bit high for me right now. You decide on a price you'd love to buy it at, a lower price. So you sell a put option. This is just a contract where you agree to buy 100 shares of that stock if it falls to your target price by a certain date. And for making that promise, yep, someone pays you a premium. And once again, the best part happens immediately. That cash, we'll call it $300, is yours to keep, right in your account. Just think about that for a second. You are literally being paid cash today simply for stating your willingness to buy a stock you already like, but at a discount. You're getting paid to wait. And this whole thing leads to two fantastic outcomes. Outcome A, the stock price stays above your target price. The option just expires, you don't buy anything, and you pocket that $300 as pure simple profit. Outcome B, the stock price does drop below your target. Great. You follow through and buy the 100 shares at the lower price you wanted all along. And since you also keep the $300 premium, your actual cost basis is even lower. You just bought a stock you wanted at a fantastic discount. So why are these strategies so powerful? Why do they work? Well, it's because when you switch from being an option buyer to an option seller, you gain this incredible statistical advantage. You're not trying to hit a home run anymore. You're just playing the probabilities. This quote from one of our sources just says it all. When you sell an option, you get to become the casino. You're no longer the gambler at the table hoping to get lucky on one spin. You're the house. And as we all know, the house has a built-in mathematical edge on every single trade. A huge part of that edge is a concept with a fancy Greek name, Theta. But you can just call it time decay. The easiest way to think about it is like a melting ice cube. Every option has a limited lifespan, and every single day that passes, its value melts away just a little bit. For the person who bought the option, that's terrible. But for you, the seller, it's your best friend. Time is literally on your side, working for you 24/7. And all of this creates a massive advantage for you, the seller. See, an option buyer needs the stock to make a big move in one specific direction to win. But a seller can make money if the stock goes up, if it stays totally flat, or even if it goes down a little bit. Your zone for making a profit is just so much wider. So really, by just reframing your thinking, from paying for a chance to getting paid for taking on a smart obligation, this whole new world of income generation can open up for you. And that leaves just one question to think about. Which role makes more sense for your portfolio? The landlord, collecting rent on your stocks, or the smart shopper, getting paid to buy them on sale?